So we've got a lot of events which affect the markets. We have economic data that is scheduled. We have companies releasing earnings. We have harvests, inventories, breaking news. Let's have a look at each one. Okay, so economic data, and I'm going to include a link again in the tools section in this course to a free section where you can get your calendar. Now we have things that come out regularly like interest rate announcements every month. We have jobs reports, CPI, PPI, which are inflation baskets. We have manufacturing from factories, and this stuff comes out every day. It may be scheduled every week or every month depending on what the data is, but the important thing for us as traders is that we make sure we understand where the risk is coming from during that day and avoid it, because what we don't want to do is we don't want to have a position on when we know we've got a big jobs number coming up. So if we've got a long on the FTSE and we know there's a big jobs report coming up in the next 10 minutes, it's probably prudent to take the position off or be prepared to sit through what could be wild volatility. So this is why we're always looking at our calendar in the day or in the week or in the month to see what could affect the markets. Now obviously each country has its own announcements. In the US we've got the Fed, in the UK we've got the Bank of England, and we have different economic reports coming out for each country, and they're going to affect things like the index of that country, the currency of the country, and then broadly obviously the stocks. Now stock specific, we have earnings. Obviously companies release earnings to tell you how they're getting on, and we've got those quarterly, we have interim reports, we have management news. So if you're long, let's say Facebook, okay, and you're thinking of holding the stock overnight, you need to be sure that they haven't got a scheduled announcement, because the problem you have if you're trading stocks and holding overnight is that once that market is closed, you can't adjust your position at all. Your risk, you've let go of full control of your risk, and whatever happens, happens. And let's say the company comes out and warns that they've made a massive miss their profit targets, the next day that stock is going to gap significantly lower. Now that's fine if you're short, but if you're long, obviously that's going to hurt. So understanding where the risk of the market you're trading is coming from, what's your daily event risk, and also knowing what people are waiting for in the market. If we're a day before some really key economic data, then perhaps the day is going to be quiet because everyone's waiting for that data. So understanding that and recognizing how that's affecting the market that you're going to trade. The other thing is the harvest and inventories. We've got what's called crude oil and natural gas inventories, which tells people how much we've got in stock. Now, that's not so important sometimes because it becomes irrelevant, but let's say everybody's looking at crude oil. We had the period a few years ago where it was very important, and people wanted to know how much crude oil we had in stock and how much was being pumped out and all this stuff, because it determined the price of crude oil. Obviously, the more scarce a commodity is, the higher the price. If the demand is going up and there's not much of it about, you get a little bit of panic and people start paying more and more for it. Same with natural gas, and that goes in swings and ebbs and flows depending on how volatile or how much volume is flowing through that market. And then obviously we have things in the soft commodities like the harvests, and we get those reports, and there's a great website for that. Again, I'll include that at the end. But in addition to that, we have to prepare ourselves for breaking news. So unexpected world-changing news, and it does come along. We have Brexit. Now, it wasn't unexpected. We knew that there was a vote. The British citizens were going to vote, but the outcome was unexpected. So there's always that surprise from unexpected scheduled news. Then we have the unfortunate things like terrorisms and deaths. So if a world leader was to die, that is going to affect a market, because people are going to think, oh, do you know what? Now the country doesn't have a leader, we may well be in a bit of turmoil. Is that going to do the economy any good? Terrorism, we have the unfortunate attacks. Less so now, the market seems to react less. But if you go back to the 9/11 events, obviously the market was devastated. It didn't know what was going on. The uncertainty caused that crash. We have technology breakthroughs. So if there's a better way of extracting oil out of the ground, then people extrapolate that and say, well, actually, oil may well be more abundant. This is going to put a bit of pressure on price, or maybe there's a better way of communicating, or whatever it may be. You know, there's always something that could affect the market or could affect your specific stock. And contracts. You've got a surprise contract, let's say with a company, they suddenly sign a huge company making contract with another supplier, then that's obviously going to affect the price of your company. So the key takeaway from this is understanding what is going to affect the market that you're trading, what is going to move the market, and knowing where your risk is coming from. The key point of being a trader is that you are managing risk. You've got your stop loss in, you know where you're going to come out of the position, you're not taking on open-ended risk. And this just shows you here, this graphic just shows you how news affects all markets. And I put specifically ones in focus because there are markets that are in focus for a few months at a time, and then it's the next market, and it's the next market, and it's understanding what is driving that trader focus. And if you look at Europe, news coming out of Europe is going to affect the FTSE, the DAX, the Euro, the Pound, the CAC, which is the French stock exchange, and the Swiss franc, just to summarize some of them. And if we move over to America, we've got obviously any news coming out of there is going to affect the Dow, the S&P 500, and your Nasdaq, your dollar, gold, potentially oil, Canadian dollar, depending on which country we're looking at. So, and there also will be a knock-on effect to Europe. So if we have very poor economic data coming out in the US, it's unexpected. The Dow, the S&P, the Nasdaq are going to take hits to the downside, and that will knock on effect to the DAX and the FTSE. So it's understanding the relationship between those. And similarly in Asia, we've got Asia and Australia, we've got Nikkei, Hang Seng, which is Hong Kong yen, the currency in Japan, Australian dollar, the Australian index, and the SSE. So these are, again, going to information coming out from these countries is going to directly affect those. But if it's very important, like we have China news coming out, it maybe will affect both US and Europe if it is completely unexpected and a complete potential game changer. So understanding the relationship of how global news flow affects each other's currencies and each other's indices. Obviously, the more impact is going to be on the immediate one, but there is definitely that knock-on effect.